Thank you, Silvia, for taking part to our virtual seminar series, the virtual seminar series of the Qatar Centre for Global Banking and Finance, and presenting your really interesting paper, Global Footprints of Monetary Policies. I would like to ask you some questions regarding this work. So let me start with this. Globally, financial markets and the markets for goods and services are both increasingly interconnected. We are seeing the emergence of global value chains and of a global financial cycle. So this makes a fertile environment for international spillovers. And your paper looks exactly at this. So what are the channels through which the effects of monetary policies are felt internationally and spill over internationally?
So thank you for having me in the seminar series. It was a pleasure to present our work. I think the main changes that we are seeing and that we should expect to be seeing going forward are mainly related to the emergence of additional channels of transmissions for domestic shocks, and really here the discussion is potentially much broader and could be involving a wider array of shocks. But in our work, we focus specifically on monetary policy disturbances. And traditionally, the way we have framed the issue of the international transmission of monetary policy shocks is really in terms mainly of its effect on the exchange rate and ultimately on current account balances. However, once, as you point out, once we bring in global value chains and global financial cycles, then the potential channels for transmissions really multiply, and they add and go well beyond the traditional trade channels. So, for example, if a monetary policy shock stems from a country which is at the center of the international financial system, then the fact that we observe very strong movements in international financial variables, which characterize the global financial cycle, mean that shocks can also be transmitted through financial conditions. And in previous work with Ellen Ray, we have documented the existence of a risk-taking channel for monetary policy that acts at the international level. So what this means in practice is that monetary conditions can influence the degree by which international financial intermediaries are either willing or able to take on risk, and this happens mostly via balance sheet adjustments. And what we show as well is that the leverage of global banks is intrinsically linked to capital flows and to global risky asset prices. So when you combine all this together, then it's quite it becomes quite clear how by altering global financial conditions, the presence of a global financial cycle can offer an extra channel of transmission for monetary policy shocks. And in a way, similarly, the presence of global value chains represent an additional channel through which shocks can be transmitted. And so, for example, even in the absence of direct trade relationship between two countries, you may have that monetary policy spillovers arise because, for example, two countries are both dependent for their production and their supply chains on a third country whose conditions are affected by monetary policy shocks, which originate in another specific country. So following the global financial crisis, I think as a profession, we have mostly focused on the first type of spillovers, which operate through integrated financial markets. But I guess the recent COVID episode has shown us how the second type of channels can actually be quite important, and this is exactly what we try to do in our paper, to sort of characterize to what extent these channels are important, and to what extent they change our understanding of international spillovers.
And so let me go on to another question. So historically, I think the literature has focused the attention mostly on the global effects of US monetary policy, but you provide evidence that monetary policy spillovers from China are important too. So how does the transmission of the monetary policy, Chinese monetary policy, differ? And are particular types of economies affected more than others?
So yeah, you're absolutely right. So the reason, and I think the reason that we have overwhelmingly focused on the transmission of U.S. monetary policy shocks so far is that the U.S. is the center country of the international financial system. And then if you take into account the fact that the U.S. dollar is the most commonly used currency for all sorts of international transactions, as well as for invoicing, and if you think that it is overwhelmingly the currency of choice when it comes to select a safe currency, anything that would affect the value of the dollar, including monetary policy, is bound to have very large international effects. So if you couple then this with the integrated financial markets and global financial cycles, then of course U.S. monetary policy becomes very relevant. And in fact, in our previous work, we have shown how the U.S. monetary policy shock can be, in fact, an important driver of the global financial cycle themselves. However, I mean, as we were just discussing, financial markets are not the only platform through which shocks can transmit internationally. And really, once you shift away the focus from financial markets back to the global production chains, then of course China becomes an important player, and one that it's capable of influencing conditions globally. And interestingly, what we find in our work is that even if Chinese monetary policy shocks seem to be quite relevant, they do seem to transmit effectively through fundamentally different channels. And in this case, in particular, financial markets really don't seem to play a relevant role. Rather, what becomes relevant in this setting is the variables such as, for example, commodity prices and the degree to which global activity and global trade can contract if you experience a slowdown in economic activity in China. Now, of course, due to these main drivers, the countries which are likely to be most vulnerable to this type of disturbances are, for example, commodity producers or commodity exporters. But I think what is actually quite interesting is that we find that even advanced economies that rely overwhelmingly on manufacturing do seem to display a non-trivial degree of vulnerability relative to these shocks. So, I mean, in a sense, we are still at very early stages of this work. And we are planning to extend it in a number of directions, including looking at how the time variation in the composition of trade and financial networks influence the transmission and the relevance and the extent to which these shocks can transmit worldwide. But our initial results suggest that Chinese shocks can in fact be quite relevant, and that they can transmit beyond the immediate neighbors.
So, given your findings at the moment, what are the implications for UK policymakers or for policymakers, let's say, in advanced economies?
So, in a sense, I think it's been already recognized in recent years that global shocks and global factors are important aspects that policymakers in general should be taken into account when designing policies. With this work, what we aim to do is to sort of shed a little bit more clarity on quantifying these effects and characterize this degree of interdependence among countries, which we hope can be useful for the design of policy. So in a sense, I mean, we are still a long way, as I said, this is still a work in progress. So we're still a long way from understanding exactly how these different channels interact. But, if the way in which, say, countries have responded to the global financial crisis can be used as some sort of guidance for what will happen in the future, I think then my sense is that this calls for a larger degree of coordination, and I think of this both at the international level, among countries, but also within the same country and among different institutions. So, for example, very similar to what has happened after the global financial crisis, when macroprudential policies were used to sort of deal with the new challenges that were posed.
So are there new challenges in the coming months, given that China's economy appears to be rebounding sharply from COVID, while most of the developed economies are still in recession?
I mean, this is clearly challenging in a sense. The situation is evolving at a very, very high speed. So I think it'd be perhaps unwise to venture any type of forecast. But and one may argue that in fact some of the channels that we document in this paper may not be active right now, because some of the restrictions that have been introduced following the health crisis mean that, for example, many firms are operating at not at capacity. So a lot of this might not be in operation in the current context. However, if we believe that our results operate in a symmetric kind of environment, I would think that perhaps rather than being a challenge, the fact that China has rebounded early might in fact provide some sort of a aid to other advanced economy in sort of boosting the external demand for their goods and services. So it could in fact not be so much of a challenge, but perhaps some a welcome outcome.
So thank you again for taking the time to respond to some of our questions, and for the great seminar you gave earlier.
Thank you very much. Thank you for having me.